Hi, Matt McAleer, Director of Equity Strategies. December 6th, just after the close here in the Cumberland Trading Room. I'm with the Moose today, John Mousseau, Director of Fixed Income, CEO of our firm. And afterwards we have a piece from David Kotak, our Chairman and Chief Investment Officer. So stay tuned for that. I'm going to jump over to John, big day in bonds with the employment report. A couple comments there. We'll circle back to what we're seeing in the equity market and take it from there.
Thanks, Matt. Well, it was a blowout day for jobs. When you think about the jobs report, when they were expecting to create about 180,000 jobs, and they created 266,000 jobs. It points out that the economy is continuing to grow. Matt will talk about the stock market and the great day it had. And in bonds, you saw a turnaround where the 10-year bond was trading around a 177 or so, and by the end of the day was close to a 184. Pretty big change. And it went from positive on bonds to a little negative on bonds. And it's continued a trend that we have seen since August, more like one step forward, 2 steps back, sometimes 2 steps forward, 1 step back. But the result being that that 10-year bond, which hit a 145 in the first week of September, is now close to a 185, and that's about 40 basis points higher. It was actually a little higher a couple of weeks ago. But the idea is the trend is towards moving towards higher interest rates. And this conforms with Cumberland's view of being somewhat defensive on bonds, because we think interest rates rise slowly over time, and they're basically catching up where inflation is, which is running around the 2.3% level on core inflation. And the idea either is core inflation rolls over and plays dead, or bond yields move a little higher. And certainly when you see a jobs report like today, it's pretty clear that there's nothing that would suggest inflation is going to move lower in an economy that's moving along like this. So this was a very good day for the economy in general.
Good. You know, John's been very consistent on the videos over the last 6 months. When the 10-year got all the way down into that 140 area, if you recall, John was on saying, from a trading standpoint, he wasn't buying the talk of recession. And he wanted to stay short on maturity, short on duration, to protect against that move back higher in rates. Now that we start to get those rates higher, I would imagine, John, if you get that 10-year up through 2, maybe you start extending duration a little bit?
Sure, that's a good point, Matt. And there's really 2 parts to that. One, Matt did make a good point. In August, we weren't buying it. We thought it was a head fake. And now, in addition to higher yields, you have a steeper yield curve, which is very consistent with an economy that's going along and doing well. And on the muni side, we're starting to get a little give, because as you can imagine, if you're a municipality and you see this very low rate in the end of the summer, you start to gear up to say, you know what, it's a good time to sell some bonds at some almost all-time low yields. And so now you have a lot of municipalities coming to market at year end, all trying to squeeze in their issuance before December 31st. So we may see a little give there, and may use that as a little bit of a buying opportunity from our defensive stance.
Good comments. Equity-wise, we had a nice move today after some early weakness during the week. Good, solid performance throughout, small, mid, and large. Growth has reestablished itself a bit against value. Let's talk a little bit about what we've consistently been seeing over the last, let's call it 8 or 10 weeks. And that's a nice bid to small and mid cap. They've been the perennial dogs versus large cap for 3-4 years now. As we've been looking at that breadth expanding, it's a positive, it's a healthy move to see small cap and mid cap starting to outperform large cap. Saw it again today. So it's something we'll keep an eye on. It's difficult to be too bearish with expanding breadth. That's more stocks being involved, more sectors being involved. On the other hand, we saw our defensive areas have some supply, have some selling in this back end of the week. Strong early, utilities, REITs, staples, strong Monday, Tuesday, Wednesday in the face of weakness. as the market turned around, you saw buyers go right to growth. That's been consistent. When the market starts to rally, money's chasing growth. So we'll see if that continues next week. I like how we're positioned. Next week we'll get into specific positioning amongst strategies. Stay tuned for David Kotok with some thoughts on today's numbers. And everyone have a nice weekend. We'll see you next week.
This was a really good employment report today, and the revisions of prior periods also good. It was a surprise. The market didn't expect it. What we see is some strategic improvement in the jobs situation ongoing in the United States. It favors the service sector. We see signs in the manufacturing sector that give us a mixed message because of the automobile strike, which has been settled. So we have a lot of wiggles on the manufacturing sector. That's not clear yet. Trade war still having some negative impacts, although in a month-to-month series you get a lot of volatility. General scheme, 160 million people employed in the United States. Their incomes seem to be rising. The job growth continues in spite of all of the turmoil and trade war. It's a good report. Markets liked it. That's why they're up over 300 points on the Dow. We'll see where the things go next year. For now, we end the year with a very good construction in the labor markets of the United States.